The S&P 500 index rose for a seventh consecutive quarter and hit a record high in June. Shrugging off political risk and a tightening Fed, investors were bullish on rising corporate earnings and signs of a recovering world economy. From January through June, the S&P 500 index earned about 9%, well above its long-term trend. A large portion of its rise was due to so-called FANG stocks, Facebook, Amazon, Netflix, and Google, highly valued industry-dominant companies. These tech titans had a 30% gain through May. However, by the end of June, they had given back some of their gains on concern over valuation. So, are U.S. stocks too expensive? When we look at the aggregate value of the U.S. stock market as represented by the Wilshire 5000 index, we see that at the end of the second quarter, the market was valued at 133% of GDP, a level not far from its March 2000 peak at the end of the tech bubble. With U.S. stocks at this level, it's not surprising that many investors have begun looking overseas for investment opportunities. In addition to trading at lower valuation levels, international equities have been enjoying an upturn in earnings growth. For example, here we see the corporate earnings growth rates of Europe and Japan have been far ahead of the United States. These different growth rates are largely due to the regions being in different stages of their economic and monetary policy cycles. For example, here in the United States, the Federal Reserve at its June meeting raised its target rate by 0.25% and set a plan to start normalizing its balance sheet by allowing securities to roll off as they mature, a process that could lift long-term interest rates and slow economic growth. When we compare the short-term policy rates of the Federal Reserve to those of the European Central Bank, we see that the Federal Reserve has been actively tightening the U.S. money supply, while the ECB has continued to provide easy money to the European economy and financial markets. This difference in central bank policy was an important driver of market returns in the second quarter. Putting it all together, for investors, the second quarter was a good quarter to be globally diversified. Among equities, international and emerging markets outpaced the U.S. on attractive perceived growth and valuation. And among bonds, global bonds beat their U.S. counterparts as non-U.S. dollar currencies gained about 3% against the dollar. Looking to the future, we have three main tactical views. First, we continue to believe that international stocks are well positioned to outperform domestic stocks over the intermediate to long term. Our view is to remain overweight international equities versus the global benchmark. Second, with the recent run-up in growth stocks, we believe that value stocks have become increasingly attractive. Our view is to remain overweight value stocks versus growth stocks. And finally, as we expect growth to recover and central banks to unwind their monetary stimulus, we believe intermediate and long-term bonds do not provide investors with adequate compensation for taking interest rate risk. Our view is to maintain a lower duration within fixed income investments. Your advisor will keep you informed as investment opportunities become available. For more information, please visit us at arnerichmassena.com. Thanks for joining us.